Welcome to Alpha Insights. I'm Jeff. Today we're digging into a topic that gets a lot of attention on small cap desks, microcap companies that are running short on cash and why they frequently show up on short seller watch lists. Joining me is Jessica. Great to have you here. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Jeff. Glad to be here. This is one of those topics where simple math actually drives big market moves.
Interesting.
Yeah, that's a good point.
So start from the top. Why do microcaps with thin cash matter right now?
Put simply, companies with a market value under $100 million and fewer than 8 months of cash on hand are much more likely to face urgent financing needs. When that happens, outcomes can be dramatic. Dilutive financings, surprise equity raises, operational cuts, or share price shocks. The timeline gets compressed, and that makes them idiosyncratic downside candidates.
And by compressed timeline, you mean?
When you look at the data, if a company's runway is under 8 months, management effectively has a single window to secure capital before things turn urgent. That raises the probability of near-term dilution or a failed financing, which markets tend to punish quickly.
Okay, walk me through the measurable filters people actually use.
Sure. Start with hard thresholds. Market cap under $100 million. Unrestricted cash under $10 million. Runway under 8 months using trailing cash consumption. Then layer in red flags like monthly cash burn above $500,000 to $1 million. Debt that exceeds cash. Short interest above about 15% of the float. A float under 20 million shares. An average daily volume under 500,000 shares.
That's a lot of numbers. How do you calculate runway in practice?
Simple formula. Runway months equals cash divided by the trailing 12-month net operating cash outflow divided by 12. So you take 12-month cash used in operations, divide by 12 to get a monthly burn, then divide cash by that monthly figure. Target under 8 months for this kind of setup.
What additional signals do you pair that with?
You want operational and market signs. Negative operating cash flow, rising accounts payable, shrinking revenue, repeated misses on guidance, and higher than normal insider selling. Also check filings for an announced financing need in the next 30 to 120 days. That can be a ticking clock.
Right.
And don't ignore borrow market mechanics. If short interest is high and borrow is available, a short thesis is actionable. But if borrow is scarce or extremely costly, that changes the risk-reward.
So tell me about sectors. Are there places this shows up more often?
Definitely. Early-stage biotech, exploration-stage mining, and niche tech or service microcaps are common sources. Biotech can flip on trial readouts, miners burn cash on drilling campaigns, and small techs can lose big revenue from one client. Those dynamics make cash critical. Interesting.
Let's talk execution and risk. Shorting small, illiquid names sounds dangerous.
It is. Shorts are as much about timing as valuation. Start with a clear thesis, an entry trigger, and a stop loss. Typical triggers include a failed financing announcement, a downgrade, or a break of key technical support on volume. For position sizing, many desks limit exposure to a small percentage of total capital, often around 1 to 2% per microcap trade, because single stock volatility can be extreme.
And the practical constraints?
Always check borrow availability and cost before you build a position. Some microcaps have borrow fees above 50% annual percentage rate, which can make even a correct trade unprofitable. Also confirm margin requirements and the risk of a borrow recall, which can force an early cover at a bad price.
Oof, that sounds like a lot of moving parts.
It is, which is why many traders use alternatives if straight shorting is too risky. Buying long-dated put options when available, using inverse sector ETFs, or running pairs trades versus a healthier peer to isolate idiosyncratic risk. Hedging is essential.
Can you give a couple quick, anonymized examples to illustrate?
Sure. Case A, development stage company with $6 million cash, $1 million monthly burn, market cap $70 million, no revenue, and $8 million of debt. Guidance assumes a financing. Classic runway pressure. Case B, Services firm with $4 million cash, trailing revenue down 40%, one client at 45% of revenue, float 12 million shares. Losing that client or a weak quarter triggers big downside. Case C, Exploration Junior with $3 million cash, drilling at $800,000 a month, market cap $25 million. A bad drill or tight markets for junior financings can push it into distress quickly. Right.
What about why some shorts fail? It isn't always foolproof.
Exactly. Companies sometimes pull off last-minute financings, land strategic partners, or get grants. Shorts can also get squeezed if borrow dries up or if unexpected positive news arrives. Cost of borrow, dividend equivalent fees, and recalls can turn a correct fundamental thesis into a loss if timing is off.
So what's a practical screening checklist someone could run?
Daily or weekly screens might include market cap under $100 million, unrestricted cash under $10 million, runway under 8 months using trailing cash consumption, debt greater than cash or debt to equity above 1, short interest above 15% or increasing quarter over quarter, float under 20 million shares, and average daily volume under 500,000 shares. Augment that with filings checks for upcoming financing needs.
Good checklist.
One final note, this is informational, not personalized investment advice. Analysts note these thresholds help prioritize research, but they don't guarantee outcomes. Markets can be noisy.
Got it. Before we wrap, give listeners 2 or 3 quick takeaways.
Sure. 1. Microcaps under $100 million with under 8 months of runway are higher probability short ideas because funding pressure compresses catalysts. 2. Use strict, quantifiable filters and always layer operational signals and borrow market data before acting. 3. Risk management. Position sizing, stops, and borrow checks is mandatory. Timing is everything.
Perfect. If you want a live run of this screen or have a question about a specific name, go to stockalpha.ai. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Jessica, thanks for joining.
Thanks, Jeff. Always good to talk through the mechanics and the risks out loud.